Did you know that the global ETF market has skyrocketed to over $7 trillion in just 2 decades? That's right, from a nascent concept in the early 2000s, exchange-traded funds, or ETFs, have grown exponentially in both value and popularity. This growth underlines a seismic shift in the investment landscape, a shift towards flexibility, accessibility, and diversity. But what exactly is an ETF? Picture it as an investment fund that's traded on stock exchanges, much like individual stocks. Yet, it stands apart. It's a vehicle that allows you to invest in a wide array of sectors, companies, and even geographical regions, all in one go. It's a tool that has democratized investing, making it accessible for both the seasoned Wall Street veterans and the novice investors just starting their journey. That's right, ETFs have taken the investment world by storm, and here's why. When it comes to investing, there's a myriad of options, so why choose ETFs, you might ask? Well, let's take a moment to compare ETFs to other types of investments like mutual funds and individual stocks. Mutual funds, for instance, allow investors to pool their money together to invest in a portfolio of stocks, bonds, or other assets. Sounds similar to ETFs, right? But here's the catch. Mutual funds are only traded once a day after the market closes, and their price is based on the net asset value calculated at the end of the trading day. This means that you have to wait until the end of the day to know how much you've paid or received for your shares. ETFs, on the other hand, are traded throughout the day, just like individual stocks. This means you can buy or sell shares at any time during the trading day at a price that's determined by the market. This gives you more flexibility and control over your investment decisions. Speaking of individual stocks, while they offer the potential for high returns, they also carry a higher risk. If the company you've invested in doesn't perform well, your investment can take a substantial hit. With ETFs, you're investing in a broad range of companies. This diversification can help spread the risk and potentially smooth out the bumps in the road. Now let's talk about costs. ETFs typically have lower expense ratios than mutual funds. This is because most ETFs are passively managed, meaning they're designed to track a specific index rather than trying to beat the market. This passive management approach requires less effort, which translates to lower costs for you, the investor. And finally, liquidity. ETFs can be bought or sold throughout the trading day, making them highly liquid investments. This is a significant advantage if you need to convert your investment into cash quickly. So, you see, ETFs offer diversification, lower expense ratios, and liquidity. 3 key advantages that can make them an attractive option for both beginner and experienced investors. With ETFs, you're not just putting all your eggs in one basket, and that's a smart move. Now that you know why ETFs are a great investment option, let's delve a bit deeper. Exchange-traded funds, or ETFs as they're commonly known, are investment funds that trade on stock exchanges, much like individual stocks. They're designed to track the performance of a specific index, sector, commodity, or asset class. This could be anything from the S&P 500, a broad market index, to gold, a commodity, or even an industry sector like technology or healthcare. What sets ETFs apart is their structure. They're actually a basket of different securities. Think of them like a fruit basket. Instead of buying each fruit separately, you buy the basket and get a bit of everything. This allows you to diversify your investment across multiple securities and spread out your risk. Now there are several types of ETFs. Index ETFs, as the name suggests, track a specific index. They aim to replicate the performance of that index, whether it's going up or down. Sector ETFs focus on a particular industry or sector, allowing you to invest in a collection of related companies. Commodity ETFs, on the other hand, follow the price of a specific commodity, like gold or oil. The key concept behind ETFs is passive investing. Instead of trying to beat the market, which is what active investing aims to do, passive investing is about replicating the market's performance. It's like going with the flow of the river, rather than trying to swim against the current. But don't let the word passive fool you. Passive investing requires patience and discipline. It's about understanding that markets have their ups and downs, but over the long term, they tend to go up. It's about resisting the urge to panic when the market drops, and staying committed to your investment strategy. In essence, ETFs are about playing the long game and reaping the benefits. Interested? Here's how you can get started. Dipping your toes in the world of investing can be daunting, but with ETFs, it's easier than you think. Imagine you're about to embark on a journey. The destination? Financial prosperity? The vehicle, exchange-traded funds or ETFs. Let's break down the process into manageable steps so that you can begin your journey with confidence. Step 1. Choose a brokerage account. This is essentially your ticket to the investment world. Different brokers offer different services, so it's important to do your research. Some brokers cater to beginners with user-friendly platforms and educational resources, while others cater to seasoned investors with advanced tools and lower fees. Consider what you need in a broker and make your choice accordingly. Step 2. Choose the right ETF. This is the vehicle that will carry you to your destination. There are thousands of ETFs available in the market, each with its own set of characteristics. Some track broad market indexes like the S&P 500, others focus on specific sectors like technology or healthcare, and some even track commodities like gold or oil. To choose the right ETF, you need to align it with your investment goals and risk tolerance. If you're seeking steady growth over the long term, you might opt for an ETF that tracks a broad market index. If you're willing to take on more risk for the potential of higher returns, you might choose an ETF that focuses on a volatile sector or commodity. Step 3. Buy your first ETF. Now that you have your broker and your ETF, it's time to make the purchase. This is as simple as logging into your brokerage account, finding the ETF you want to buy, and clicking the buy button. You can choose to buy a certain number of shares, or to invest a certain amount of money. The choice is yours. But remember, investing is not a one-time event. It's a journey. It's important to regularly review and adjust your portfolio as needed to ensure it remains aligned with your investment goals. You might need to rebalance your portfolio from time to time, or you might decide to add new ETFs as you learn more about investing and become more comfortable with taking on risk. Investing in ETFs can be an exciting journey. It's a way to participate in the financial markets, to grow your wealth over time and to work towards your financial goals. And the best part? You're in the driver's seat. You get to decide where you're going, how fast you get there, and what route you take. And there you have it. You're now ready to make your first ETF investment. Our recommendation is to automate investing. Set up a standing order from your bank account. At the same time, set up a savings plan with your broker. Once the money is deposited in your broker account, the savings plan will be executed and you will never forget your next step to financial wealth. Investing in ETFs is a journey, not a sprint. Remember, we've just scratched the surface of the vast world of exchange-traded funds. We've talked about the ETF explosion, how they stack up against other investments and what they are at their core. We've also given you a beginner's guide to investing in ETFs, but remember, this is just the start. The beauty of investing is that there's always more to learn, more to explore. And the best part? You don't have to go it alone. Continue to do your research, ask questions, and stay curious. Start small and let your knowledge and your portfolio grow together. Remember, patience and consistency are your best friends on this journey. Investing is not about getting rich quick, it's about building a solid financial future, one step at a time. If you found this video helpful, don't forget to hit the like button and subscribe for more investment tips. Here's to your investing journey. The information provided in this video or communication is for informational and educational purposes only. It is not intended as and should not be considered financial, investment, legal, or tax advice. The content is based on general principles and may not be applicable to your specific financial situation or needs. Always consult with a qualified financial advisor, accountant, attorney, or other professional before making any financial decisions or taking any actions related to your finances. Any investments or financial decisions you make are solely your responsibility. Past performance is not indicative of future results, and there are no guarantees of any specific outcomes or returns. While every effort has been made to ensure the accuracy and completeness of the information provided, we do not warrant or guarantee its accuracy, reliability, or suitability for your individual circumstances. We do not endorse or promote any specific investment products, services, or strategies mentioned in this video or communication. Any references to such products, services, or strategies are for illustrative purposes only, and do not constitute a recommendation or endorsement. You should conduct your own research and due diligence before making any financial decisions. In summary, this video or communication is not financial advice, and you should not rely on it as such. It is essential to seek professional advice tailored to your specific financial situation and goals before making any financial decisions or taking any actions.